All right, let's be clear. For the next 1 to 2 weeks, the government shutdown is really the only thing that's driving this market. It's causing a ton of volatility and, maybe more importantly, a data blackout. So this is our framework to cut through all that noise.
You look at the headlines, right? It's shutdown chaos. People are talking about an AI bubble. There's just so much noise. So where's the actual signal? That's what we're going to do. We're going to cut right through it, focus on the hard data, see what the big institutions are doing, and come up with some real actionable scenarios.
Okay, here's the plan. We've got 5 parts. First, we'll establish the shutdown as the main driver. Then, we'll look at sentiment versus what the institutions are actually doing. Third, we'll zero in on the key sectors under pressure. Fourth, we'll outline our market scenarios and how to position. And we'll wrap it up with some specific, defined risk option setups.
All right, Section 1, the shutdown. It is the primary driver right now. We're going to start with the hard data, what consumers are feeling, and what history tells us about these events.
So the first real signal we're getting is this number right here, 50.3. That's from the University of Michigan's Consumer Sentiment Survey. And look, that is dangerously close to an all-time low. This isn't just some abstract number, okay? This is a direct measure of fear. It shows you that the anxiety is spreading from DC right out to Main Street. But here's the flip side, and this is absolutely critical. History gives us some context. Yeah, markets get choppy and volatile during a shutdown, but look what happens when it's over. They tend to rally, and rally hard. The data shows that 86.4% of the time, the market is positive once there's a resolution. This is the bedrock of our bull case.
Okay, let's talk about the immediate risks because they're very real. You've got key inflation data like PPI and retail sales delayed. They're not coming out. That means the Fed and frankly the entire market, we're all flying blind. We don't have the data we need. On top of that, the Labor Department is warning that things like unemployment insurance and SNAP benefits are at risk. That's a direct potential hit to consumer spending.
All right, Section 2. So we've established that consumers are scared. But what is the big money doing? How is institutional capital positioned? Are they buying this fear, or are they hedging for even more downside? Let's find out.
And the options flow is, well, it's pretty telling. We flagged 2 really significant bearish positions here. First, a $1.5 million bet against Lam Research in the semi space. But look at the second one, a massive $5.2 million put-debit spread on KBE, the banking ETF. That's a huge defined risk bet that financials are headed lower all the way out to June 2026. Make no mistake, this is not retail messing around. This is big institutional capital putting on hedges against a serious, prolonged economic slowdown.
Okay, Section 3. Let's drill down now into the specific sectors where you can really see this tension playing out. We're going to focus on the key price levels, the lines in the sand that are defining this bull versus bear battle.
For semis, you have to watch NVIDIA. It's the bellwether, period. And the levels here are crystal clear. You've got support holding around 180, the upside resistance is at 190, and then again at 200. Whichever way this range breaks, well, that's likely going to dictate the next big move for the entire tech sector.
Now let's talk about the banks. KBE. They're looking pretty vulnerable. Remember that big bearish options trade we just talked about? Well, this is where it comes into play. That wasn't just some random bet. It's a signal of real institutional concern that if this shutdown drags on, it's going to cause a material slowdown, and financials will be right in the crosshairs. Now, on the consumer side, let's look at a potential contrarian idea, Starbucks. What's interesting here is you have a potential double bottom pattern forming right at a key support zone that's between $78 and $80. So if, and this is a big if we get a shutdown deal, this is a name you've got to watch for a potential sharp reversal to the upside. So if all this macro fear really does trigger a wider market correction, what's on our watch list? We're focused on high-quality tech. We're looking for an opportunity to pick up names like Meta and Adobe, but only if they get sold off because of broad market panic, not because something is actually wrong with their business. Our analysis, based on DCF and PEG metrics, shows there's some compelling value at lower levels on these names. Okay, before we get into the specific scenarios and the trade setups, just a quick but very important disclaimer. This content is for educational purposes only. What we're doing is aggregating public information to help you stay informed and make your own decisions. You have to do your own research. This is not financial advice. And just one more quick thing. If you're finding this helpful, please take a second to hit like and subscribe. It really does help. Your support tells the algorithm that this is valuable content, and that helps the channel grow. I'd really appreciate it. All right, Section 4, Market Scenarios. This is where we put it all together. We're going to take all that data and synthesize it into 3 clear scenarios: a base case, a bull case, and a bear case. This will give us a clear framework for how to be positioned.
So here are the specific triggers that define which scenario we're in. For the bull case, we need 2 things: a shutdown deal gets announced and SPY breaks and holds above 674 resistance. For the bear case, the trigger is the shutdown extending, threatening holiday spending, confirmed by a decisive break below 668 support. These levels are critical. You should verify them on your own charts.
Okay, our base case, and we're assigning this a 60% probability, is basically more of the same, just continued chop. We're expecting the shutdown to drag on for another week or 2, which should keep the SPY pinned in a range between that 668-670 support and 672-674 resistance. So what's the posture? It's defensive. We're talking 40% cash, reduced long delta exposure, and keeping those hedges on the vulnerable sectors.
So what's the bull thesis in a nutshell? It's pretty simple. A shutdown resolution removes the single biggest weight on this market. That triggers a sharp relief rally, which we know is backed up by historical data. All that cash sitting on the sidelines, it comes flooding back in, deployed into those quality tech names that got sold off because of fear, not because of fundamentals.
And the bear thesis is just as clear. It's that the political gridlock just doesn't end. It persists, and it starts to cause real, tangible economic damage. That awful consumer sentiment number we saw earlier, it's not just a number anymore, it translates into a real drop in spending. And that would completely validate those big, bearish institutional flows we saw coming into the banks and semis.
Okay, last section, Section 5, Defined Risk Options Setups. Let's walk through 2 specific structures that align with the scenarios we've just laid out.
First up, a bearish hedge on the banks using KBE. The thesis here is pretty straightforward. Hedge against a potential economic slowdown caused by the shutdown. The structure we'd look at is a put-debit spread, maybe something like the December 50 by 45. What this does is give you a defined risk way to express that bearish view. We're basically riding the coattails of that big institutional flow we saw. Your max loss is capped at the net debit you pay for the spread. And what kills this trade? A shutdown resolution. That's your invalidation point.
Okay, setup number 2 is that potential bullish reversal on Starbucks. The thesis is a technical bounce off that $78 to $80 support zone, with the catalyst being a market-wide relief rally. A way to structure this would be by selling a cash-secured put, for example, the December 77.5 strike. You're trying to exploit the elevated implied volatility around that key support level. Now, a critical warning here. Options involve substantial risk. When you sell a cash-secured put, you are obligated to buy 100 shares at the strike price if the stock falls below it. Losses can be substantial, so this is not a strategy for everyone.
And let's wrap it up with one final reminder. This is not trading advice. It's a market update designed to keep you informed. All markets carry risk. The most important thing is to trade your own plan, always manage your downside, and please verify all this data for yourself.